Ever wondered why Bitcoin is $50,000 one day and $42,000 the next? Or why your friend bought a coin called Fluffy Shiba Moon at breakfast and by dinner it was worth zero? Cryptocurrency prices jump up and down like a hyperactive kangaroo. And in this video, we're going to explain why. Hi, my name is the Crypto Teapot. Don't worry, I'm keeping things super simple. No charts, no complicated math, just real-life analogies, light humor, and a few relatable examples that'll finally make this whole crypto roller coaster make sense. Let's get into it. Okay, first things first. Why does any price go up or down? It all comes down to two words: supply and demand. Let's say your local town only has one pizza place. They sell the best pepperoni pizza in the universe. Now imagine everyone in town suddenly starts craving that pizza at the same time. What happens? Prices go up. The pizza shop knows people are willing to pay more, so they raise the price. Now flip that. If suddenly nobody wants pizza because everyone's doing a kale cleanse, the shop has to lower prices to attract buyers. That's supply and demand in action.
The same rule applies to cryptocurrencies, except it's not pizza. It's digital coins like Bitcoin, Ethereum, or Dogecoin. If lots of people want to buy Bitcoin, but there aren't many people selling, the price goes up. If everyone suddenly wants to sell their Bitcoin at the same time, maybe they read some scary news, and there aren't enough buyers, the price drops fast. So when you see Bitcoin spike or crash in a single day, it's usually because more people are buying or selling than usual. Sometimes it's excitement, sometimes it's fear. Often it's both.
Now, here's the thing. In the crypto world, supply is often fixed. For example, there will only ever be 21 million Bitcoins. That's it. No one can make more. So price mostly depends on how many people want it, which can change every single second. Think of it like concert tickets. If there are only 100 seats and 10,000 fans fighting to get in, prices skyrocket. But if no one's showing up, ticket prices drop faster than a DJ's bass line. And unlike traditional markets like real estate or the stock market, the crypto market never sleeps. It's open 24/7, which means prices can change at 2 a.m. while you're peacefully dreaming of owning a Lumbo. Plus, emotions play a huge role. Investors are human, and humans are, well, emotional. Some days people are super optimistic. They call it bullish. Other days, everyone's panicking. That's called bearish. No actual bulls or bears are involved, sadly. But the mood swings cause wild price swings. And in crypto, those swings happen fast. In a nutshell, prices change because of supply and demand, and in crypto, demand can shift wildly thanks to hype, fear, or even a single tweet. Next up, how news, influencers, and social media can send crypto prices soaring or crashing in seconds. Alright, so we've talked about supply and demand, but what actually drives that demand in the first place? Three things: news, influencers, and hype. Let's start with news. Imagine you wake up and read a headline: government bans crypto. Yikes. That kind of news freaks people out. Investors start panicking, and they sell their coins as fast as they can. The price drops hard. But the next week, you see a new headline: major bank starts accepting Bitcoin. Suddenly everyone's excited again. People rush to buy, and the price shoots up. It's like the market has emotional mood swings based on the headlines of the day. And in crypto, those headlines come fast. Sometimes real, sometimes rumors, and sometimes totally made up. Now, let's talk about influencers. Believe it or not, a single tweet from a famous person can make or break a coin. No joke. Elon Musk once tweeted a single word: Doge. Just that. And Dogecoin's price exploded. It's like if Beyoncé posted about a brand of hot sauce. You can bet that hot sauce would sell out in 5 minutes. In crypto, people follow influencers like prophets. So if a celebrity or YouTuber says, "This coin is going to the moon," boom, demand goes up. Everyone rushes to buy. But here's the problem. It's not always based on facts or real value. It's often just hype. Like a viral TikTok, dance, fun, exciting, but doesn't last forever. And when the hype dies down, people start selling and prices crash just as fast. Then there's social media in general. Reddit threads, Discord groups, Twitter storms. These places are like giant rumor factories. Somebody might say, "Hey, this tiny coin is the next big thing." And before you know it, thousands of people pile in, hoping to get rich quick. But once early buyers take their profits and leave, latecomers are stuck holding a bag of disappointment. So yeah, news can scare or excite people. Influencers can spark mass buying frenzies. And online hype can create temporary price bubbles that pop as fast as they form. It's like a giant group chat where everyone's yelling "buy now" or "sell everything." And prices move with the noise. Here's the short version. Prices don't just move because of math. They move because of feelings, tweets, and FOMO. That's fear of missing out. Which brings us to why crypto is extra volatile compared to traditional markets. So, we've seen how supply and demand, emotions, and internet hype cause prices to rise and fall. But now you might be wondering, why is crypto so much more dramatic than, say, the stock market or real estate? Great question. Let's break it down. First, crypto is still pretty new. Bitcoin was invented in 2009, which makes it younger than Instagram. Compared to other financial systems that have been around for centuries, crypto is still in its teenage years. And like most teenagers, it's a bit unpredictable. There are fewer rules, less regulation, and way more room for wild behavior. Big players, also known as whales, can make huge trades that shake the entire market. Imagine someone buying or selling billions of dollars worth of Bitcoin in one move. That's like doing a cannonball into a kiddie pool. Major splash. Second, crypto markets are thin. No, not diet thin. Thin in terms of liquidity. That just means there aren't always a ton of buyers and sellers at any given moment. If you try to sell a couch on Craigslist, but only one person is interested, you might have to accept a lower price. Crypto works the same way. In smaller markets, with fewer people trading, prices can swing wildly just from one big buy or sell. Now add in the fact that anyone, anywhere can trade crypto 24/7, even with just a smartphone, and you've got the perfect recipe for chaos. No closing bell, no weekend breaks. Crypto is like a casino that never shuts down, and that means prices can change while you're brushing your teeth or walking your dog. Third, many people are in crypto for fast money. Let's be real, a lot of folks aren't investing in crypto because they believe in blockchain technology. They're hoping to turn $10 into a Lamborghini by next Thursday. That kind of mindset leads to quick buying and even quicker selling. The second prices dip, people panic and bail. The second prices rise, others pile in hoping to catch the wave. It's not investing. It's FOMO-fueled gambling, and that makes the whole system twitchy. Finally, there's no clear way to measure value yet. With a company stock, you can look at profits, customers, revenue, and all sorts of boring but useful numbers. But with crypto, how do you decide what something is really worth? It's not always clear, so prices are mostly based on belief, and belief changes fast. Some coins have strong communities and long-term goals. Others are just memes with a funny name, but they all trade in the same marketplace, making it hard to separate the serious from the silly. In a nutshell, crypto is extra volatile because it's young, lightly regulated, super accessible, emotionally driven, and full of people chasing fast gains. And unlike traditional markets, there's no off switch. So, why do cryptocurrency prices fluctuate so much? because they're like a mix of pizza demand, celebrity tweets, teenage drama, and FOMO, all wrapped up in a 24/7 global market with no rules and no bedtime. If you found this breakdown helpful, or at least entertaining, give us a like and hit that subscribe button. We've got plenty more videos on the way to help you understand crypto without the confusing lingo. If you have your own question, drop it in the comments. I'll pick the most liked one and break it down. Stick around, it's gonna be fun.